Welcome back to PodWavePulse. One of the things that constantly amazes me is just how interconnected the global economy really is. And today, we're going to take a deep dive into one of the most consequential and frankly fascinating relationships out there, the economic ties between the US and China.
It's a relationship that often feels like it's teetering between cooperation and competition.
Exactly. You shared some really compelling research with me that takes us way beyond those surface-level headlines about trade wars and tariffs. I think our mission today is to really try to untangle this web, see how deeply these two global powerhouses are intertwined, and try to grasp what's at stake for both sides. Let's be honest. When we're talking about the US and China, we're talking about the world's two largest economies.
Absolutely. The decisions they make, the policies they implement, they reverberate across the entire planet.
And one of the things that really jumps out when you start looking at the numbers is this. China owns a truly staggering amount of US debt. We're talking about something like $800 billion in US Treasury bonds.
Yeah, that's not a figure you can just brush aside. It immediately raises the question of leverage. What kind of power does that give China over the US economy?
Exactly. It's like they're holding this massive IOU, and you have to wonder, what could they potentially do with it?
Well, let's think about it this way. If China were to suddenly decide to dump a huge chunk of those bonds onto the market, what would happen?
Basic economics, right? Supply and demand.
Exactly. You flood the market with US Treasury bonds, the price of those bonds is going to drop. And when bond prices fall, yields go up.
Yeah, higher yields mean
higher interest rates across the board.
Yeah. And we all know what that means. Mortgages get more expensive, businesses think twice about investing. It could really put the brakes on the US economy.
It's a potential weapon for sure, although one that carries significant risks for China as well.
It's like a game of economic chicken.
Yeah.
But as the research you shared points out, it's definitely not as simple as just China holding all the cards.
Right. It's a two-way street. China also depends heavily on the US in a number of key areas.
Like what? Give me an example.
Well, let's take rare earth minerals.
Okay, those are crucial for what? High-tech stuff, right?
Absolutely. Smartphones, electric car batteries, even advanced weapon systems, they all rely on rare earths. And China, they pretty much dominate the global supply chain for those minerals.
So that gives them a ton of leverage, too. Imagine if they decided to restrict exports.
Oh, it would send shockwaves through the global tech sector, that's for sure. The U.S. is trying to diversify its sources, but it's a long road.
And then, of course, there's the elephant in the room, the thing we all see every time we walk into a Walmart.
You're talking about the sheer volume of goods that China manufactures for American consumers.
Exactly. It's everything from clothes and electronics to toys and furniture. Cheap, affordable goods that have become deeply integrated into American life.
It's created this massive interconnected web of trade, trillions of dollars flowing back and forth across the Pacific.
Which brings us to this term that your research uses, fragile interdependence.
Yeah, that captures it perfectly. Both sides benefit from this relationship, but they're also deeply reliant on each other, which makes them vulnerable.
It's like they're both walking a tightrope.
And if either side stumbles, the consequences could be pretty disastrous.
So let's talk about potential missteps. What are the biggest dangers for each side?
Well, for China, I think the biggest risk is overplaying their hand. If they try to use those treasury bond holdings as a weapon too aggressively, they could trigger a financial crisis that would ultimately hurt them too.
Like a boomerang effect.
Exactly. They need the U.S. economy to remain stable just as much as the U.S. does.
Okay, so what about the risks for the U.S.?
I think the main concern is over-reliance. The U.S. depends too heavily on China for those rare earth minerals, for manufactured goods. It makes them susceptible to supply chain disruptions.
Especially if geopolitical tensions were to flare up.
Precisely. And we've seen how fragile those supply chains can be in recent years.
Yeah, just think about what happened during the pandemic.
It's a wake-up call. And that's why both sides are actively looking for ways to diversify, to become less reliant on each other.
So let's talk about China's strategy for reducing its dependence on the U.S. The research you shared highlights two key initiatives, the Belt and Road Initiative and the dual circulation policy.
Right. Let's start with the Belt and Road Initiative. This is absolutely massive in terms of both its scope and ambition. Imagine China building this colossal network of infrastructure roads, railways, ports, pipelines stretching all across Asia, Africa, and even into Europe.
It sounds almost like a modern-day Silk Road.
That's a good analogy. It's about creating new trade routes, new economic partnerships, and expanding China's influence far beyond the U.S.
That's like they're building a whole new economic sphere.
Exactly, and it ties directly into their second strategy, the dual circulation policy.
Okay, break it down for me.
Think of it as two interconnected loops. The first loop is about boosting domestic consumption and innovation within China itself.
Becoming more self-reliant.
Exactly. Reducing their need for foreign markets and technology. That's where companies like Huawei and SMIC come in. They're pushing hard to become global leaders in things like 5G and semiconductors.
Yeah, they want to control their own destiny in those key sectors.
And the second loop is about diversifying their international trade partners. They're forging closer ties with countries in Southeast Asia, Africa, Latin America, reducing their dependence on the U.S. market.
It's a long-term strategy, but it seems to be working.
Yeah, it's a slow and steady shift, but the implications are huge.
And then, of course, there's the currency game. China's been promoting the yuan as an alternative to the U.S. dollar in international trade.
Right. They're making deals with countries like Russia and Saudi Arabia to settle transactions in yuan, bypassing the dollar altogether.
So, could the yuan actually challenge the dollar's global dominance?
It's still a long shot, but it's a trend worth watching. The dollar is deeply entrenched as the world's reserve currency, but cracks are starting to appear.
Especially as the U.S. racks up more and more debt.
Yeah, that's a whole other conversation.
Let's get into it. I mean, we can't ignore the elephant in the room. This massive $34 trillion national debt hanging over the U.S. economy.
Yeah, it's a truly staggering figure, and it limits the U.S.'s options in dealing with China.
So what are some of the ways the U.S. might try to manage this debt? The research you shared talks about the possibility of dollar devaluation.
Right. That's essentially allowing the value of the dollar to weaken relative to other currencies.
Okay, but how would they do that?
Well, one way is through low interest rates. When borrowing is cheap, it encourages more spending and investment, but it can also lead to inflation, which erodes the value of the dollar.
And wouldn't that be a problem for China? They're holding all those U.S. Treasury bonds.
Yeah, if the dollar weakens, their holdings lose value. It's estimated that a 20% devaluation could cost China a whopping $160 billion.
Wow, that's a huge hit.
So it's in China's best interest for the dollar to remain strong, at least for now.
Which creates this fascinating standoff. China can't really dump those bonds without hurting themselves. And the U.S. can't ignore the risk of dollar devaluation.
It's a classic case of mutually assured economic destruction.
Well, this whole situation sounds incredibly delicate.
Delicate, complex, and constantly evolving.
Speaking of evolving, let's shift gears and talk about the digital frontier. The U.S. and China are also locked in a race to dominate the future of money, right?
Absolutely. We're seeing this play out in the world of cryptocurrencies and central bank digital currencies, or CBDCs.
Okay, so for anyone who's not immersed in the world of crypto, let's start with the basics. What are we talking about here?
Essentially, it's a new form of digital money that operates outside of traditional banking systems. Cryptocurrencies, like Bitcoin, use cryptography to secure transactions and control the creation of new units.
And the U.S. is taking a kind of cautious approach to this whole thing, right?
Yeah, they're still figuring out how to regulate this new technology. We've seen the approval of Bitcoin ETFs, which allows investors to bet on the price of Bitcoin without actually owning it.
But they're also exploring the idea of creating their own digital dollar, right? A CBDC.
Exactly. The Federal Reserve is researching the potential benefits and risks of a digital dollar. It could potentially offer faster, cheaper, and more secure transactions, both domestically and internationally.
But China's already way ahead of the game, aren't they?
Oh, yeah. They've been aggressively developing and testing their own digital yuan. They've even banned decentralized cryptocurrencies like Bitcoin so they can control this new digital landscape.
So it's a centralized approach versus a more open, decentralized system.
Exactly. Both approaches have their pros and cons.
So what are the potential implications of all this? I mean, what happens if the digital yuan becomes the dominant global currency?
It could be a major power shift. It could undermine the U.S. dollar's dominance and give China greater control over international finance.
So it's not just about technology, it's about geopolitics too.
It's all interconnected. The future of money is deeply intertwined with the balance of global power.
So to wrap this all up, it seems like this U.S.-China economic relationship is a lot more than just tariffs and trade deals. It's a multi-dimensional chess match with incredibly high stakes.
That's a great way to put it. It's a competition that will shape the 21st century.
And it's playing out on multiple fronts: debt, trade, technology, and now digital currencies.
And the outcome is far from certain.
Well, I think we've covered a lot of ground today. Thank you for sharing your expertise and helping us unpack this incredibly complex relationship.
It's been my pleasure. It's a topic that deserves a lot more attention and discussion.
Absolutely. And for our listeners, if you want to keep exploring the fascinating world of global economics and the future of money, be sure to subscribe to our channel for more deep dives like this one. Thanks for listening.